Scott, let me bring you in here. You oversee $8 billion in assets. More than half of that is exchange-traded funds. So you allocate amongst your portfolio using ETFs very liberally. Investors seem interested in treasuries this year, but not that interested in equities. And I'm curious about that. What are you seeing, and what are you advising your clients now about equities?
Yeah, Bob, you're right about that. I mean, we have seen a lot of interest, a lot of renewed interest in the fixed income world in general, and really like the cash world specifically. So kind of the short-term space where you can get paid 4 and 5%. With that's understandable to some degree. I mean, look, we haven't had any gains in global equity markets for almost 2.5 years, and so people are kind of tired of waiting. And so the interest in kind of short-term high-yielding sorts of instruments, we think has made some sense over the last 6 to 12 months. But we think over the next 6 to 12 months is probably the wrong place to be. Because if we are in sort of a disinflationary period, and we've seen the peak of inflation and we've seen the peak of rates, we think the equity allocations, even though they're shunned and they're hated right now, they're probably going to be a better place to be for investors, as we come into the summer and the fall time.
It's amazing, Scott, in equities, how negative the sentiment is. And of course, this is bullish because people are on the sideline, but nobody seems to want equities these days. It seems to me that there is an opportunity here. I want you to expand on your point that you just made. Negative sentiment, number one. Number two, the possibility that inflation is coming down, the Fed is done cutting rates. And number three, earnings keep holding up pretty well. This earnings recession that we've been waiting for 6 months, so far hasn't happened.
Yeah, and look, you're right. I mean, we've been waiting for this recession, the most forecasted, obvious recession in the history of the world for over a year. And it's always 6 months away. And we think in 6 months, it's going to be another 6 months away. This is an economy where we have an underlevered U.S. consumer. We have an underlevered U.S. corporate stance. People are spending money, companies are making money, and rates have peaked. That's not a bad backdrop overall. And just like you said also, Bob, the fact that sentiment is very poor and very bearish, it just adds some fuel to the fire. So, it's going to be rocky. I mean, look, we still have debt ceiling worries, and we still have things to worry about. But overall, we think that the positive catalysts and the positive stories for this market, why this thing can go higher over the next 6 to 12 months, are really underappreciated right now.